Good afternoon, everyone. Today I'm chatting with Rick Rule. In today's interview, we discuss Elon Musk, Donald Trump, and Doge and why they were unable to make all of the cuts that they originally promised. We also get into gold equities. Rick tells us what names he likes and what it would take for Rick to invest in a high-risk exploration company in 2025. Also, guys, if you want to connect with people in the gold world, well, you got an opportunity to head down to Boca Raton in early July to meet the man himself. Also, the Deep Dive staff will be there, so if you decide to come down, make sure to stop by our booth and say hello. Information for the Rule Symposium is in our description below. All right, everybody, enjoy the interview. Rick, thanks for joining us again.
Pleasure to be back. Thank you for having me again.
So there's lots of areas we can start with, but I think that there's something we talked about a few months back, we'll say, and you ended up getting this call right. And I thought I'd maybe congratulate you on this one. Was when Elon and Trump decided that they were going to join forces and go and start slashing government spending. I asked you about it because I think I had you on a few days after this announcement of the Department of Government Efficiency, and you laughed it off and said, "Great, we get another government department that's going to end up not doing anything." And they started out; they were going to cut 2 trillion. Then the number came down to 1 trillion. Then it was like 175 billion, and now there's reports that it could be even less than 20 billion that they ended up actually cutting. Um, are are you surprised that you were right about this? Did we learn anything from here? Was there any good to come from what Elon and Trump did?
I think they popularized the idea that I think maybe they popularized the idea that government and efficiency weren't competing concepts. Uh, but no, they didn't accomplish anything. They're both pretty good promoters, and there was a lot of sound and fury coming in. If they found all the fraud, where were the indictments? I didn't see any indictments. If they found a bunch of waste and abuse, how come the proposed Trump budget has the fourth largest deficit in recorded history? How come the debt ceiling had to be raised? If you're as old as I, heaven forbid, you remember the Reagan Revolution. Unlike Trump, Reagan won by a landslide, and Reagan won specifically on an agenda to cut government. Uh, Trump had a lot of, rightist social agendas too. But Reagan was all about cutting the size of government. Um, David Stockman, a good friend of mine, was the director of the Office of Management and Budget in the Reagan years, and he wrote a wonderful book called The Triumph of Politics that describes the bipartisan Republican and Democrat derailing of the Reagan Revolution within 6 months of inauguration. If you lived through that period of time and paid attention, you understood that the Department of Government Efficiency was fraud itself, that it wasn't going to happen. Um, Mr. Trump, like most politicians, is a transactional human being. Uh, he's not particularly an ideologue. He uses ideology to get elected, but he's transactional. Uh, Policy is all about rewarding allies and punishing adversaries. In that sense, he's identical to Biden, who was similar to Bush, who was like Clinton. You know what I'm saying? And so, no, it was no surprise to me. It's unfortunate. I would love to have been wrong, but I thought the probability that I was wrong was minuscule. Unlike many commentators, I took the time to read Mr. Trump's book, The Art of the Deal. In The Art of the Deal, he talks about the fact that there is not two winners in a transaction. There's only one, and your job is to crowd the other person out of the transaction. Um, that's a typical political point of view. In business, ideally in a transaction, both the buyer and the seller won. So they get together and do business again. That's how businesses grow and how trust develops. But that's not how government works. Government's a zero-sum game. So it was no surprise to me that unfortunately I was right about the failure of the Department of Government Efficiency.
Now, let's talk about what's happened with the price of gold. Obviously, we have you on. We have an audience of we mostly cover the equity side of gold, which we obviously are going to get into. Having you on here, somebody who's been doing it probably as successfully and as long as pretty much anybody we're going to get to talk to. But we look at the price of gold. What I think's happening right now, and this is kind of when I first became interested in the gold space, was I was actually a former teacher before I was here, and I remember teaching a an economics class once where a kid asked me about where's all this money coming from, and it was shortly after the time that Ben Bernanke first said the words quantitative easing. And that's when I started asking questions and started thinking about how do economics really apply here? And I think that when we first heard those words, there's obviously a lot of hysteria on social media about how, okay, they can just print whatever amounts of money they want. But eventually that was gonna catch up with us, and it seems like everything that's happening right now and, you know, there's all these talking heads online that talk about it. Peter Schiff's been going on about it for decades, but it seems like now is the point where it's all the rubber's kinda hitting the road in that these deficits are unsustainable. It's gonna end really badly. It seems like what's happened with the price of gold is that we could say global capital markets or central banks are kind of coming to this realization that we're getting near the end point of quote unquote Keynesian economics. What's your viewpoint here? Tell me what's going through your head when you look at the price of gold, and am I on the right track there?
Yeah, I think your monologue was pretty accurate. I would maybe pick a couple points of disagreement. First of all, you didn't used to be a teacher. You're still a teacher. It's just that you have to earn your students now. They're not delivered to you by the state. And you have a chance to deliver a real curriculum, unlike the curriculum that you used to have to suffer through. Let's get that one out of the way first. But with regards to gold, you're mostly right. I would argue, when people would say to me in interviews in 2022, 2023, when's the gold price going to move? I would scratch my chin sagely, and I would say, I think it's going to move in the year 2000. It was 250 bucks an ounce then. When they were asking me, the stuff was already over 2000. It had moved up eightfold, and people would say, when's it going to move? Perhaps they were looking for a more quantum move. In truth, I think you're right about the convergence of events. I think it was Hemingway, when asked how he went bankrupt, he said slowly at first, then all of a sudden. Uh, we have been building up unsustainable debts in our system for a long time, but at some point in time, it reaches the critical point. Many people, because the system is liquid, believe the system is solvent, and those are very, very, very different words. Imagine yourself having, let's say, $1 million in mortgage debt, and an annual income of $65,000 and being overextended in your credit cards, that kind of thing. But you have $5,000 in your pocket. You're liquid, but you're not solvent. And I would suggest to you that that's the way that the United States is. And I would suggest that people are coming to reason with it. When people say to me now, "Okay, Rick, accidentally, you were right. The price is at $3,400. Have I waited too long? Has the gold bull market run its course?" That's the next logical question, of course. And I answer that these days by uh, telling people what would cause me to sell my gold. And that's pretty easy. I will sell my gold when there's a real balanced budget in Washington, provided that that balanced budget provides for the timely repayment of $30 trillion in net on balance sheet liabilities. In addition, there needs to be a fiscal plan to deal with the $100 trillion net present value of off balance sheet liabilities, a politically feasible plan to deal with Medicare, Medicaid, Social Security, federal government pensions, military pensions. So that has to happen. And there has to be a real positive interest rate. By positive interest rate, I mean that the interest on the US 10-year Treasury has to exceed the rate in the deterioration of the purchasing power of the US dollar. I believe that the US dollar's purchasing power is proceeding at a compound rate between 7.5 or 8% a year. Uh, with the US 10-year Treasury rate at what, 4.5? That would suggest a 10-year treasury rate at 9.5. It would suggest a first mortgage rate at 12%. So when I see a positive real interest rate, when I see the end of quantitative easing, when I see a political accord that pays off $30 trillion in the net present value of not net present value, pardon me, in the aggregate value of government debt, and when I see a politically feasible plan to pay down or service $100 trillion in off-balance sheet liabilities, and oh yes, a balanced budget, I'll sell my gold.
Yeah, I gotta ask you about. I assume you've seen this, and I'm not gonna pull what a reporter pulled on Donald Trump yesterday and make this news to you. But are you familiar with the taco trade?
I'm now familiar with the phrase, yes.
And for our audience, maybe we can cue up the clip for them to see, but Donald was blindsided by being asked about the taco trade. He had never heard of it before. And the acronym TACO stands for Trump always chickens out. So traders on Wall Street have found this trade now where Trump acts like a hard negotiator with the tariffs, and then the market starts to go down as everyone thinks that he's actually going to follow through, and then ultimately there's some sort of pause or some sort of backtracking or something happens that ultimately makes everything come back. So effectively, it just means buying the dip whenever the markets get a little bit freaked out because of Trump. You think that this is a trade worth people actually trading?
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I think that that acronym is applicable to younger traders. Older people like myself think of the pal trade. Politicians always lie. Uh, you could tell they're lying when their lips are moving. If you go back to the point in time when Mr. Trump has proposed these things, at the time of proposal, they were preposterous. Now, I, unlike most of the traders, took the time to read Mr. Trump's book, The Art of the Deal. And in The Art of the Deal, he outlined his negotiating strategy. He said that you approach your adversary, not as a customer, but as an adversary, and you make an absolutely preposterous ask. And you make the process as unpleasant as you can. Call them names, use factoids. Factoids are facts that aren't true. Bluff, bluster, make life miserable for them, and then be prepared to settle for much less than you ask for, but more than you would have got had you not made a preposterous ask. In other words, the negotiating techniques that he's used against 100 adversaries are precisely the ones that he told us 20 years ago that he would use. Most of the people who are criticizing Mr. Trump now forgot to read his book. I took him at his word. Of
But is there collateral damage from it? I mean, like,
course,
is.
of course, of course. I mean, first of all, you don't win a fight by picking 100 fights. You win
Mhm.
fights one at a time. What was his percentage, other than it amused him, to make comments about Greenland or annexing Canada? I mean, who wants all those voters from Ontario and Quebec anyway? What was his percentage in taking on the Chinese when in many of the areas that he was trying to take them on, they had an advantage? How do you project America's strength when you rely on foreign investors for US credit? How do you maintain the US industry's strengths in a diversified supply base? We have a globalized supply chain. All of his techniques, if you think about it, and by the way, I'm not anti Trump, or maybe I am, in the same way that I was anti Biden, anti Clinton, anti Obama, anti Bush, anti Carter. Um, but the idea that, well, I guess because people are young. I was taken in by Reagan in 1980. That's the last time. These guys aren't going to fool me.
You make a good point about the idea that you don't wanna negotiate against too many opponents at once, especially like when you actually think about it that way of going and taking on 100 negotiating opponents at once. It's just as you continue to fold to various partners, you lose all your leverage with all these other counterparties that you're negotiating against. So it almost kind of seems like they made up everything that they're doing out of the White House right now on the spot. Like when Trump announced his plan for Gaza to basically turn it into a beautiful real estate development, just watching it and seeing Netanyahu react to it, it almost just seemed like Trump came up with that on the spot, and Netanyahu was blindsided by it.
I have to say that Trump is more amusing than his predecessors. Amusement is not what I want from a president, but I have to say his flights of fancy are amusing. And I have to say, one thing I do like about Trump is the outrage that he causes the granola class. Unfortunately, he outrages me too. Uh, but I'm sort of generous with my outrage. I have to say that watching the apoplexy that Trump causes Elizabeth Warren and Kamala Harris and AOC is worth some of the disutility he causes me as an American and the embarrassment he causes me when I travel abroad. I do have to give him that.
I saw a hilarious meme. I'll send it to our editor for him to see it, but it was the cover of Pretty Woman with Julia Roberts and Richard Gere, but they switched it to AOC and Bernie Sanders, and instead of saying Pretty Woman, it said Pretty Stupid.
I wish they were stupid. I don't think they're stupid. I think they're evil. Uh, you make a mistake underestimating your opponents. Unlike Trump, I try to fight one or two at a time. I will say I enjoy, as you probably know, engaging in Socratic dialogue, thus far unanswered, with AOC among others on X. And it's a lot of fun.
Yeah, I've been watching it. Let's get into the equity side of the
Great.
business because obviously that's what our channel's mostly on. I could talk to you about politics all day. I always enjoy your commentary. But we've we're in a roaring gold market here. We're seeing some earnings come through. I don't think that I'm seeing the kind of operating leverage open up that I would have expected at $3,300 gold, if I'm being honest with you. You seem a little bit shocked by that statement.
Yeah.
Now we are seeing it. If we look at the 1 year chart, we've got companies like Agnico Eagle and Kinross. They're absolutely flying. And don't get me wrong, they are printing cash. But when you think about the equity side, let's maybe start with the basket of those larger operators out there. Which are the companies you're excited about right now?
Well, the companies that you've talked about have blown away earnings estimates, including, I'm embarrassed to say, my own. Um, Wheaton buried my estimate. Lundin buried my estimate. Alamos, Kinross. I had an aggressive, I thought, estimate for Agnico Eagle, and they buried me. One one thing that people who are younger than me don't know about the early stages of a gold bull market, and that's this. During periods of low gold prices, the industry often produces gold deposits uh, at a higher grade than the median reserve, which is a fancy way of saying they high grade. So if the median reserve grade that you have in your mineral inventory is 1.5 grams, what you find is during periods of low gold prices, these guys are often producing 2 or 2.3 gram material. That is, they're high grading. When they are running lower grade material through at the same costs, of course, their cost of goods rises. The second thing that happens, at least it happened in 2023, is that while the gold price was moving up, the inputs around around producing gold moved up. So although the gold price moved up in 2023, the margins didn't move up because energy costs went up, wages costs went up, wage costs went up, and in particular, social rents, taxes and royalties went up. In 2024, the move in the gold price began to be substantial enough that margins in the more efficient producers happened. What you're starting to see now a little bit is the hangover from high grading. When you look at the income statement and the balance sheet of gold producers on a quarterly basis, an annual basis, it's important to look at the variance, which they have to report, between mined grade and average reserve grade, and find out if the company is in fact high grading. Because if they are high grading, what you will find is that in subsequent years, they'll have to pay a penalty for the relatively better results than they otherwise would have had to report were they not high grading.
I really appreciate that answer because that kind of makes everything make a lot more sense for me when I think about where we are today. It's not to say that these companies aren't producing cash. It's unbelievable the cash flow that they're putting out. It's just it's not quite at that level that I had expected, but that's because they're now able to go and get that more we'll say bulk ore. I don't know what the term I want to use is. I want to ask you about Newmont because Newmont recently they set out to sell $2 billion worth of assets, or sell. I think was it 9 assets for $2 billion. They haven't even sold all of them, and so far they've got $4 billion for them. Newmont's now trying to concentrate on what they define as tier one assets. So that's as they define it. I think it's like 500,000 ounces a year. It's got to be on the lower half of the industry cost curve. What else? It's got to have a 10-year mine life. What do you think about Newmont's strategy? You think it's smart for Newmont to be unloading some of their lesser exciting projects?
I do. I think it's a very good strategy. I think it's good for the industry. I think it's good for Newmont. I think it's good for Newmont shareholders. Newmont had too many mines. The consequence of having too many mines, the negative consequences of having too many mines was at least twofold. The first was that they couldn't afford to make sustaining capital investments at all their mines, particularly during periods of lower gold prices. The second thing was that they couldn't manage that many mines. They couldn't lavish the love, care, and attention, never mind the capital, on a 20 mine portfolio. They couldn't do it. By doing what they did, they've done two good things. They have freed up their own time, talent, and capital on the one hand. And secondly, they've turned what are potentially company changing assets for smaller companies to those companies. Uh, an asset can be a bad asset for Newmont because Newmont has to starve it for capital and starve it for love, while at the same time being a great asset for a smaller company that can focus on that asset and turn it into what it otherwise would not have been. Imagine that you and I are Newmont. Imagine that we need to maintain 6 million ounces of production a year, which is to say we need to replace 6 million ounces in mineable reserve every year. We don't do that in 1.5 million ounce chunks. The arithmetic doesn't work. We have to do it in 5 million or 6 million ounce chunks. Uh, Newmont has done the right thing. It remains to be seen because they're not going to turn Newmont around in a quarter. You need to uh, adjust for years of deferred sustaining capital investment. You need to adjust for years of management time and attention diverted too far. But it's a great start. And as you point out, their budget was to receive $2.2 billion. They've received in excess of 4, with lots more to come. Uh, this has been wonderful for them for many reasons. We will see how long it takes for it to show up in the AISC numbers, and we will see the extent to which uh, producing at above reserve grade comes back to haunt them in coming quarters.
What's wrong with Barrick? I look at Barrick over the last 5 years, their stock price is down 21%. And we look at the price of gold, obviously it's probably what nearly tripled over the last 5 years, or definitely doubled. Why why is it that Barrick hasn't seen more progress in their equity?
Barrick has the hangover now from the party that they enjoyed 15 years ago when they pooched their balance sheet. Barrick had to spend 6 years getting solvent, and during that time, they couldn't grow. And again, they had to defer sustaining capital investments. They had to defer new project investments. And Barrick now is paying the cost. Their balance sheet's in good shape. They can grow now. They're ready to go. But they are paying the cost of having to spend 6 or 7 years repairing the damage that they had done to themselves in the last decade. Their growth strategy is an interesting growth strategy. The market will not like it. Mr. Bristow has said correctly, I think, that for the most part, increases in gold production in tier one deposits will come from copper mines. The lowest cost gold producers are the guys who cover their costs from copper. And the ability to find, buy, build a major gold deposit will likely occur. Let's just call it a copper company and drag. The way he's chosen to express that has been Reko Diq, a deposit that I was in a small way helpful in financing the discovery of. This is a top 10 deposit.
In
What?
in Pakistan, right?
Yep, yep.
Yep.
This is a top 10 deposit worldwide, but it's in a lousy part of a lousy country. Balochistan has problems with factions that express their dissatisfaction for each other by killing each other. It's a hard place in a hard country. Bristow has done this before. I watched Bristow, make Kabali work. I watched him make Lualoo work. He is used to working in tortured sociological and political jurisdictions, and the institutional investor is never like that. Uh, Whether or not he can make it work here remains to be seen. At the same time he's making that work, he and Newmont must uh, contain rising costs in their core portfolio in northern Nevada. The creep in AISC in northern Nevada, and I would suggest the underfunding of sustaining capital investments and new project investments has to turn around. Uh, Both Newmont and Barrick have to make their existing operations work before they worry too much about growth. In Barrick, in particular, uh, the perception is going to be hard because of the concentration of free cash flow that they get from Africa and their growth concentration in Pakistan. Whether it works or not, the market in the near term won't like it. I watched Mark Bristow with Randgold from inception. I was around when they started it. Some would say I'm old enough that I was there when the gold was implanted in those projects, but that's different. I watched him build Randgold from scratch in very, very, very difficult countries in very difficult circumstances with great geology. And I have a lot of time for Mark Bristow. I've watched him for 40 years.
So before we started, we were talking a little bit about exploration companies, and it brought me to what I think is a very interesting question. Is because people see that I have access to you because you're kind enough to come on and chat with me, so that our audience gets your commentary. And so people see you and I chatting, and they reach out to me and go, "Steve, can you introduce me to Rick?" And they're typically CEOs or GOs of early stage exploration companies, and I always just kind of like have to brush it off and be kind, but I know that most of the time that they ask me about it, I'm probably wasting your time if I bring it to you. You're a busy guy. You don't have time just to see any exploration asset. I'm curious, just because I do have people reaching out to me saying, "Can you introduce me to Rick so that he can see my deal?" What is it that would excite you if somebody came to me with an exploration company and they said, "Steve, introduce me to Rick. I think he's going to be interested." What's that criteria look like for you to look at something early stage?
Uh, Tell them to go to the Rule Classroom in Introduction to Natural Resource Investments, where I have 9.5 hours of programming for free about how you analyze juniors. So the first thing that they should do is invest in themselves. You're probably doing them a favor not to introduce them to me, by the way. A project which amuses me is we'd like to do something at the Rule Classroom like Shark Tank, where we take all comers. Anybody who wants to come on and be interviewed by me can do so for a fee. We charge them, and it's live. And we put them through the same questions that we instruct our students at the Rule Classroom to do. So let's give people a short form. First of all, luck favors the trained observer. The people around a junior have to have been successful previously in a task that's very similar to the task at hand. If your mythical junior comes to me and the guy says, I've been successful in mining, and it turns out that success was that he was the president of an operator in Archean terrain in French-speaking Quebec, but what he's doing today is exploring for gold in tertiary terrain in Spanish-speaking Peru. I'm not much interested because the success doesn't translate. The second thing is that I'm going to ask him or her, what is your most important unanswered question? Uh, how did you arrive at that question? In other words, what's your thesis? What facts support the question? How do you propose to answer the question? What is the answer worth? How long will it take and how much money will it take? I've been asking that same range of questions for 40 years. And 80% of the time I answer the question, the person I'm asking the question to says, I've never thought of it that way. Now, that's as though you're walking from San Francisco to Marin across the Golden Gate Bridge and you're heading due east. If you don't have a plan, you are certain not to achieve your plan. When I ask people to describe their most important unanswered question, it turns out that for at least 80% of the respondees, their most important question is, will I be drawing a salary from this company 2 years from now or not? Yes or no? Well, I understand that's of interest to them. It's of no interest to me whatsoever. The second thing is that when I look at balance sheets and income statements, I notice that in most juniors, more than 50% of the capital raised gets spent on general and administrative expense, which is to say less than half goes in the ground. When I was in university, I learned that a mineralized anomaly had a 1 in 3,000 chance of becoming a mine. So my frontline odds are already lousy, 1 in 3,000. But if more than half the capital raised is going into G&A, not into the ground, the odds are by definition half as good as 1 in 3,000. So the person I'm talking to is going to have to explain to me why their general and administrative budget will be less than 20% of the capital that they raise. Uh, that would put them in the best decile of juniors worldwide. I would suggest to you that there are probably around 3,000 public companies worldwide that purport to be mining companies. US OTC, Australia, Canada, AIM, all this kind of thing. And I would suggest that between 85 and 90% of them are valueless. They're worth nothing. So I start with the proposition that 10% of the companies I talk to, I'll be interested in proceeding with. That hides the fact, on a positive side, that 5 or 10% of the listings generate so much performance, particularly in the market that we're coming into. Make no mistake, we're coming into a raging gold equities market. That they add legitimacy and even luster to an industry where 90% of the listings aren't worth the paper that they're printed on. So I hope at the Rule Classroom that we can work through the regulatory challenges of allowing any prospective company that wants to meet me and wants to be introduced to the 70,000 investors who subscribe to my services, in a 1-hour session where they present their presentation, and then I respectfully but forcefully ask them questions around their presentation. I suspect that a company that got through that questioning in good order would be immediately rewarded by my investor base. And I suspect that some of the companies that went through that ordeal would never be able to raise money again.
Well, Rick, I appreciate you taking the time to do this. As always, our audience absolutely loves when you hop on here. Quickly, let's just talk about the Rule Symposium, high level. What's happening for our audience? Even if they can't make it to Florida in July, how can they attend?
Well, good point. Um, Let's start by saying this conference has gone on for 30 years successfully. So we've done something right for a very long time. You make something a little bit better every year for 30 years, it ends up being pretty good. And ours is pretty good. In fact, it's great. You can attend live or via live stream. I would prefer it if you came to Boca because there's lots of conversation, lots of knowledge that is nonverbal. You were there last year. You understand what that means. But if you can't, we had attendees from 33 countries last year attend via live stream. Uh, and that's great. Whether you attend live or live stream, know this. We're going to give you between 50 and 55 hours of intense, valuable programming over 4 days. And that's more than you can absorb. To that end, two things. Recordings of the entire proceedings, including all the breakout sessions, will be available to all attendees for a year after the conference. And to get the most out of the conference, you're going to have to replay the tapes, probably more than once. The second thing is that unlike any other conference in the world, I interview every exhibitor and most of the speakers that will be at the conference before the conference. I post those interviews at the Rule Classroom and also at the Rule Investment Media channel on YouTube so that you can, frankly, whether you attend the conference or not, familiarize yourself with every exhibitor before the conference. That allows you to utilize your time and your capital at the conference much more efficiently. We deal with the tyranny of time because we steal the 4 months before the conference to familiarize you with all the topics. After the conference, you have access to the tapes, but we also have discussion groups at the Rule Classroom so that you can compare notes with other investors. That's important. We start the way we started this interview with big picture macro, but we don't do big picture macro with tired old journalists. This isn't CNBC macro. We have David Stockman talking about US politics, the debt and deficit. He's speaking in a biblical sense from the belly of the beast. He ran the Office of Management and Budget under Reagan. We have Daniela DiMartino Booth talking about the Fed because she was a Fed researcher. She's not an observer. She was a player. Nomi Prinz talks about Wall Street as a former partner of Goldman Sachs. We move on from there to portfolio managers who have been in natural resource-based businesses for 20 or 30 years. Not somebody who failed at crypto and failed as a bond analyst, but rather seasoned veterans of natural resource investing who have managed billions of dollars. Importantly, every single one of our exhibitors, every single one, is owned and accounts owned and managed by the conference sponsors. So they're all vetted. At every other conference I know of, the qualification to be an exhibitor is simply a check that cashes. Our conference is very different. We have to own you or you don't appear. We turn down more exhibitors than we accept. That allows me to make an offer that's absolutely unique. No other conference sponsor offers this. Whether you attend live or via live stream, if you aren't absolutely happy with the value we provided, we will refund you your admission fee. No other conference has a satisfaction guarantee. Now, in 30 years of offering this guarantee, I've had to refund less than 1/10 of 1% of the tuition that I've charged. But that notwithstanding, your personal guarantee from me is that I provide value for money or you don't pay.
All right. Well, Rick, I'm looking forward to seeing you there. Hopefully, we have a chance to have some drinks on the cruise ship, which everybody who attends, I believe, is invited to buy a ticket on.
You
And
you buy a ticket, but we will sell out. I could sell out a battleship for that cruise. So if you want to go on the cruise, by all means, make your reservations now.
awesome. Well, Rick, thanks for doing this as always, and I will see you in July.
I really look forward to it. We're going to have a really good time, and the timing for this conference is superb. Not only are we going to have a good time and learn a lot, we're going to make a lot of money. Attendees at last year's conference made good money. Attendees at this year's conference over the next couple of years, I suspect, are going to make great money. You'll remember, as an example, that one of our exhibitor keynotes last year was Agnico Eagle. Imagine a company that size, that low risk, doubling in 12 months.
Thanks for hopping on, Rick.
Thank you.
All right, everybody. Thank you for watching. If you enjoyed this interview, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody. Thanks for watching.